we're going to be talking about this new balance sheet for a few minutes, and then we're going to talk about a new way to do investing such that you only have upside risk relative to a base living standard. And that's called upside investing. And that's particularly important in these days with all the volatility in the stock market. And then after about, hopefully just about 20 minutes of talking about this stuff, Rick and I are going to have a general conversation about the economy in response to any questions that you have. We have Dan Royer from our company. He's in charge of customer support for MaxiFi. And my son Alex is trying to get the internet, was working fine from where he is, but just died right before the whole broadcast began. Of course, perfect timing. Do you want to say anything, Rick, before I just do this quick demo?
Well, it was very kind of you to refer to me as a great economist, but I don't think that's really true. I haven't been a practicing economist for quite a while. I think it would be coming up on, one is embarrassed to say, but coming up on 40 years. So, but it is true that I did get my Ph.D. from Chicago.
Well, you certainly are an economist, and you sound like an economist when you talk about the economy. So you know a ton of economics. Anyway, so let me start by sharing my screen, and let's see how we're going to do that. That's not the answers. Oh, can you people can see my screen at this point? Can Rick, can you see my screen?
I can see your screen.
Okay, can everybody see that? The slideshow?
Looks like it. Looks like it's fine, Larry.
Okay, good. Okay, so again, just it's economic security planning. Thank you so much. There are potentially 1,700 people on this call, from what at least the number of people that registered. And we're recording it, so we'll have it posted on our website shortly. And Rick may put it up on his site, which is sensiblefinancialplanning.com. We also have Jay Fula, who's a financial planner, on the broadcast. He's also an economist, and he's helped us quite a bit with this new design of the lifetime balance sheet. So without further ado, I will kind of start us off here and see if we can get some of the switch. Why isn't it advancing?
Maybe expand your screen, Larry, make sure it's full screen. If not, I'm not sure. I think it is, but I can see it okay.
Oh, wait, it just went away.
Just went black. Yeah, there you go. You're good again.
Let me lower that and see if we can. So I'm hitting advance. It's not. Oh, okay.
There we go.
That good. Okay, so here we go. So we have these are the key websites that I wanted to just reference really quickly. MaxiFi.com, MaximizeMySocialSecurity.com, my personal academic website where I put up all my columns and academic articles and podcasts. LarryKotlikoff.substack.com is a new newsletter that I just started. It has about, I don't know, 15, 20 newsletters I put out in the last couple months. You can go to that URL and subscribe. You can subscribe for basically everything I've been putting up for free. So I haven't been forcing anybody to pay for anything. At some point I might try and raise a little money out of this, but feel free to subscribe on a paid basis. That will help me do more of these. If you like the newsletters, do more of them, and or if you don't feel it's worth it, just subscribe on a paying basis. Just buy it, subscribe for free. No problem. So Rick's website again is this one, and our agenda, as I said, just review this new lifetime balance sheet, and it should be out in production on Sunday. We'll have this new upside investing also in production, and then we're gonna have this Q&A. It can go on for up till 7 o'clock Eastern if you'd like, or if even longer. I'll stay. So the new balance sheet, I'm going to take an example of a guy named Rob, lives in Missouri, 60-year-old male, single, $1 million in regular assets, $50K in a nominal pension. We're going to assume long-term 5% inflation, 5% nominal return, so 0 real return. He's got a $25,000 a year a month Social Security benefit starting at 67. He has $1.5 million in IRA, $1 million in regular assets, $750 house, no mortgage, and $17,500 in other housing expenses. So the base profile report for this guy Rob is looks like this now. This is the if I run his base case, things look a little bit different. In particular, we have his assets coming in here, and the housing, real estate expenses are over here, and the resources are over here. Now, you can see the discretionary spending is 1.98 million. And the key thing I want to do right now is show you these expanded housing entries. So we have real estate assets, are there. That's the house. He's got no additional future borrowing for his home. If he did, we would have higher mortgage expenses showing up here. So higher borrowing would show up, and on the other side is higher payoffs. And then real estate appreciation is showing up here. We're assuming no real appreciation beyond just inflation. And the real cost, the real return on assets and regular assets is 0. So there's no holding cost. And that holding cost I'm going to get to in a second, but it's really the opportunity cost of sitting in your home. If you have a house where, let's say you have this, like he does, the $750,000 house, and doesn't want to sell it, then he's going to leave it as a bequest, and that's entered right here. So that's going to go to the kids or other heirs, and he won't be able to, if he does sell it, let's say, and rents for $1 a year, then his discretionary spending would go way up because he'd basically be able to untrap that equity, that trapped equity. But that's a rather pejorative term. You could also think of it as, hey, saving the house to leave to the kids. Maybe he's got a kid, or, well, I said he was single, but yeah, he does have a kid. And so now let's look at the case where but there's also no hold opportunity cost, because it's not like if he sold this house, that if he sold it, he could take the $750 and start making some interest income above inflation, because I'm assuming the real interest income is 0. And now,
Larry, if we go back just for a second.
Yep.
So I don't want to just brush past the major benefits that we get here from adding housing to the lifetime balance sheet. It makes explicit the fact that your home is an asset, and it makes explicit that when you bequeath your home, in effect, you're spending that asset, and you can spend it in other ways. As Larry said, one could think of it as trapped equity, but one can think of it as an asset that one can access for all kinds of purposes. And one could imagine, for example, selling the home later in life and renting, and freeing up equity that way, and thereby enabling a higher level of discretionary spending. So I think that there's a real advantage created for users here in understanding or incorporating and explicitly incorporating the value of the house as an asset on the balance sheet.
Yeah, thanks for correcting that. That's definitely the case. The now, let's see. Okay, for some reason this one, I've been having trouble with PowerPoint all day. I don't know if anybody else is having problems with a new version, but anyway, this was not quite coming out the way it's supposed to. Here, yeah, I had sold the house, and somehow this screenshot from the prior run just oh, no, I'm sorry. I take it back. This is actually correct. So here's what I do here. I sell the house and have the guy rent. So this is exactly what Rick was just talking about. Look at this. This the 750 in the bequest that was going to go to the kid disappears, but it's showing up partly in higher discretionary spending. But why doesn't the discretionary spending go up by 750,000? Well, because his housing expenses also went up because I have him selling the house in 20 years. He's currently 60, so he sells it at 80. His maximum age of life is 100. And of course, this report assumes that he makes it to 100 because we're looking at that kind of worst case scenario. And he's going to rent such that his housing costs actually are higher. They were 717,000. They're now 892. So that lowers how much he can spend on the discretionary, put into the discretionary spending because he's got more tied up in spending on housing. On the other hand, he can spend this, what he might call trapped equity, the 750. So on balance, his living standard gets to go up. And of course, there's going to be some differences in taxes as well, associated with everything that goes on. When you change your discretionary spending, it changes your saving, it changes your asset income, it changes your taxes. Okay, so here's trying to illustrate this other thing, which was zero before, which was the holding cost. And the holding cost here is the fact that in this case, I set the real return to be 2%. I said he could earn 7% nominal, 5% inflation, so there's a 2% real return. So if he were to take that house, the $750,000 house, and sell it and invest it, he could earn 2% right through well, he could earn 2%, but he's not selling the house. He's holding on to the house in this example. So the opportunity cost that he's giving up is earning 2% real on 750 every year for the rest of his life. And in present value, that comes to this amount of money. Now, the equity bequest, it was 750 before, but in present, we were discounting it as zero real return. Now we're discounting at the 2% real return. So the equity bequest is actually smaller. So if you have, if you're going to leave, let's say a $2 billion house to your kids 50 years from now, and that might seem like $2 billion, but if the real return was 10%, they wouldn't need to have $2 billion today to get to $2 billion 50 years from now. They could have a whole lot less and get to $2 billion 50 years from now. So the present value, the value in the present of that 2 billion would be much, much smaller. And that's what you're seeing here. The value of the 750 when you discount it at 2% real is smaller. So here, again, he's not selling the house, but because there's so where's the house value going? It's going in two places. It's not being invested. That's the cost of not investing it. You're, in effect, you're paying rent to yourself. This is really picking up the what we economists call the imputed rent, the opportunity cost of sitting in the house and not either investing the proceeds or renting the house out to somebody else. you're renting it to yourself. So this is the cost that you're incurring. And we hadn't been showing that before. I want to make clear that the balance sheets we had before were perfectly correct in the sense that they balanced, but they didn't show everything. You know, if you have a balance sheet, it's always basically, you know, X plus Y plus Z on the left-hand side and X plus Y plus Z on the right-hand side. But you can always add W to both sides, and W may be important to C. And then you can all add, U to both sides, and U may be important to see. And that's kind of what we've done here. We've added a few extra things that we thought were important to see that we were kind of under the rug calculating, but not exposing in our prior versions of the software. So this is how this person, Rob, is spending his $750 home, $1,000 home. He's basically renting it to himself, and he's basically leaving it to his kids. And the two things together come up to the pretty much the number. Now, here's I want to tell you about the upside investing demo. And the idea here is that upside investing for old users of ES Planner Download, where we used to have, we had upside investing in the program. We've brought it into MaxiFi, and we're discontinuing the download program because it can't be supported given the old Visual Basic technology that is going out of use. So upside investing is going to be added by our engineers to the software again on Sunday, just like the new balance sheet. The new balance sheet is going to be a little bit different from what I just showed you, because the holding costs, we have something about on the left-hand side involving real estate appreciation. So we are going to be modifying this slightly to make that holding cost net of the real estate. If you have like a really good, a house that's really appreciating, then the holding cost, let's say you could earn 0 on the market real because the rate of returns, the real safe, maybe the return on inflation index bonds is 0 like it is pretty much today. It's the 30-year TIPS return right now is about 0.5 basis point, but it's been basically around 0 for quite a while. So if you think about 0, say, okay, but I've got this house in California that I think it's going to go up 3% a year above 0 in real terms, above inflation. So that's like a negative holding cost. So we're going to be subtracting this housing appreciation that people can enter into the program as a negative holding cost rather than showing it up as a positive over here. So one thing with balance sheets is you can add X to both sides and it's a fine balance sheet, but you can also take something over here and subtract it from something over there, and it's a perfectly fine balance sheet because this side will go down by that amount and this side will go down by the same amount, and the balance sheet will still balance.
I will say, Larry, just to go back to that point though about having the balance sheet balance, you've tried, I think, to design the balance sheet so that it makes intuitive sense, and so that, especially on the asset side, a user can identify the components of the balance sheet. So labor earnings, Social Security benefits, future employer retirement account contributions, the current value of retirement assets, the current value of the house. All of those are things that people think of as assets, and having the balance sheet structured that way, I believe, is very helpful in making it more user-friendly. And I think that's another change that's been made that isn't quite as easy to show. But I think that the balance sheet is now more user-friendly, a bit more user-friendly than it was, in addition to being more complete with the addition of real estate equity.
Yeah, thanks, Rick. Yeah, I think employer retirement account contributions I'm not sure they were included here before, but they are now. That's like an extra resource that we had solicited from users, but we hadn't actually shown it as a separate resource. And okay, so anyway, upside investing. So those of you who are familiar with running the Monte Carlo report in MaxiFi know that what you do there is you specify a safe rate of return as that you're going to use to make your spending decisions. You're going to sit here, let's say, at whatever age you are, and say, well, here's what my assets are. I don't know what the market's going to bring, what my return is going to be, but I'm going to spend as if I'm going to earn, let's say, zero real. I'm going to spend conservatively. And then the program will figure out, hey, how much should you spend this year if you really were going to earn zero for the rest of your life? And then that's going to determine this year's living standard for your household. But then it's going to take a draw of your assets, so the returns on your assets from this random distribution based on the assets you're holding, the portfolios you're holding, and it's going to bring you into the next age. Maybe you're currently 50, we're going to bring you to age 51, and we're going to do the whole thing again. We're going to say, what would you spend at 51 if you're sitting here with these assets? Maybe you got good returns, so you did better than expected. So you get to spend a little bit more, but on a safe basis. And then the next year, and then we bring you into age 52 and say, oh, let's do it again. Now, maybe you got a crappy return, so now you cut your spending. So you get to see the trajectory of your living standard. And in the standard Monte Carlo, we run 500 of these trajectories. We show you the 5th percentile and 25th percentile and so forth up to the 95th percentile of the outcomes of these trajectories. Like the 95th percentile is the trajectory, is the trajectory that generates the 95th highest realized present value of spending across all the 500 trajectories. Now, upside investing is a little bit different, but it's really cool. The idea, which I got from Zvi Bodhi, emeritus professor from Boston University, who's pretty famous in this world of personal finance. So he's he's written a couple books about kind of safety. One's called Safety First Investing and risk-free investing. So the basic idea is, as we've implemented it here, is you say, let's take a chunk of my assets and keep them perfectly safe. I'm not going to invest them at risk. I'm going to invest them in safe securities. And the context here would be inflation index bonds is the safest security that you can buy. Let's say 30-year Treasury tips, Treasury inflation protected securities that are yielding, as I said, about a 0.5 percentage point today. Now, the other aspect of upside investing is that you take the money that you're not putting into tips and you put it into the stock market. And that's the two investment vehicles we have in mind when you run upside investing, like the S&P 500 and tips. And the money in the stock market is viewed as your casino, money in the casino. And the key thing about it is you get to decide how much you're going to have in that casino right on day one when you're running the program, right now when you're running the program, and how much you might be adding to your to the casino, how much extra you might be putting into stocks over time. So you tell the program how much more you'll be putting into the stock market. And then the program runs assuming every single penny that's in the casino is lost entirely. Okay, and that determines a base living standard floor. So this is the first program that, first financial planning software program to actually develop a living standard floor as opposed to an income floor. There's lots of programs out there that purport to give you an income floor through some bucketing methodology, which is highly suspect for reasons I can discuss in the Q&A. But the basic thing is this is generating a living standard floor, assuming that every single penny in the stock market, every single penny you add to the stock market is lost entirely. That's your floor. And then we run these 500 trajectories, Monte Carlo trajectories. But here what we do is we ask the user, we'll ask you, look, if you don't lose every single penny in the stock market and you reach, what age would you like to start converting whatever you have in the casino, take it out of the casino and put it into tips, convert it from stocks to tips. At what age would you start to would you like to start that conversion? What age would you like to stop? So this person, Sally, she's got these different, attributes here, earns 100K, 200K in regular assets, 500K in an IRA, zero real return on safe assets on the tips. She's got, of her 500K in the IRA, she's got half of it in stocks. And the 50K she's in her checking account, she's just keeping in safe. And she's got a $500,000 or so house, 15K in housing expenses. That's Sally. She lives in Michigan. So what does her base plan look like? Well, this is with no upside investing. If she were just to invest everything, every single penny in tips, earning nothing above inflation, by assumption here, not the 50 basis points, but zero, her discretionary spending is 1.7 million, and her annual living standard is about 34,000. So, and she's single, so that's also her discretionary spending because she's got a family of one. Now, here's the upside investing. The first thing to see is that this red line here is the living standard floor. You see it says floor here. And that floor is below 34,000. So she gave up something by putting money into the stock market, because if it's entirely lost, she will just be living at this floor, which is around $31,000. She'll be giving up $3,000 a year that she could otherwise spend for sure. So she is, making a sacrifice to play the casino. The casino has very good odds that you're not going to lose at all. And here's the 500 trajectories. And the green one is the 95th percentile. And you can see they're all above the floor. And they all start going north. Should have had started going up when in about 10 years. I'm not sure why that one just, well, it's actually, yeah, might be a little bit of a glitch, but basically the idea of these trajectories is that they're all looking like this, and they're all above the floor, and they're all based on Monte Carlo simulations. So I'm going to say one other thing, and then we're going to turn it open to Q&A, or Rick might have some comments. This is what the new reporting menu is going to look like. We're going to have these deterministic, no Monte Carlo simulation, no risky investing reports, the base plan, the maximized plan, the survivor plan. We're subsequently going to have probably a sensitivity analysis plan where we can on the fly change your retirement age or change the rate of return or the inflation rate, maybe maximum age of life. So these are going to be like what we call deterministic no uncertainty reports. And then here we have the living standard Monte Carlo reports, and they're the upside investing report. And we call this we're calling what we used to call the Monte Carlo report full risk investing, because there's upside and downside in that when you run it under that assumption that you're going to spend out of your risky assets. The key thing about Sally is she's not spending out of the casino money until she actually withdraws something from the casino when she turns, I think I had her starting this at age 60. And that's, so for 10 years, she has no sequence of return risk. She's just leaving the money in the market to do whatever it does. After 10 years, she starts gradually pulling it out over the next 15 years. Every time she takes money out, she takes the money out and puts it into tips. But she gets to spend a little bit more because she has more safe assets. So that's why she has an upside to her floor. That's the upside living standard picture, is that these are now new higher levels of her floor associated with these different trajectories. So there's only upside to her floor. And the new reporting screen is going to look like this. And it's just pointing out that both of these different risk analyses, investing at risk analyses is using Monte Carlo simulations to do its work. So Rick, do you have any comments about the upside, about anything before we move on?
Well, I think one thing, Larry, that you were concerned about is the trajectory crossing, and I guess I wouldn't be concerned about that necessarily because it's just one trajectory, right?
No, the trajectories can cross because I could be doing well early on and then do poorly.
Right.
And then, but I'm always, so I've got the money in the casino. I made a huge winning on the blackjack, and then I move over to play the slots, and I start losing money. And on this other green trajectory, I'm just sick of the, maybe this trajectory, some other trajectory. I'm just staying at the blackjack table. So every year you're taking out whatever is in there, and you're absolutely right. There's no reason these things can't cross. What I was a little concerned about is that this seemed to be jumping up a little bit too early. I told the program to wait till, so all these things should be flat until age 60. So we're gonna have to double check that before we make this public, that it's actually not jumping the gun here on terms of the withdrawals. But but anyway, I think this is, let me just say before we head over to the Q&A, and Alex, by the way, did you get on?
I don't think Alex got on yet.
I think he made it on. Okay. All right. Well, Dan, you may need to handle the Q&A if you can for us, just to start at least, and then I can pick it up after a bit. But people should be entering questions in the chat box. But the key thing I think about this is that most people play the market this way. They don't rely on the stock market to sustain their lifestyle, at least if they're in the middle class or lower end of the income distribution, because they know it's such a risky ride. This year, today, the market fell yet again. The decline in the market's been about 22%. That's about the typical decline as well as the typical increase in the stock market in a given year. In recent years, the market's just gone up and up and up, and we've lost the idea that the market can decline, but it declined by 86% in the Great Depression. It declined between 29 and 33, it declined by 53% in the dot-com bubble when it burst. It declined by 50% in the Great Recession. It declined by 53% between 2008 and 2009. So the stock market is a great casino because its average return is about 6.5% above inflation. Historically, if you go back to like 1950, recent decades, but it's a very risky proposition. And of course, if you take the money out early in the next, right after the market drops and then the next day goes up, then you're facing the sequence of return risk, which a lot of people have written about over the years, which is that you're at risk to have taken your money out too soon, just right before the market went up. And of course, there's also, positive risk there because you could have taken the money out right before it went down. But on balance, if you leave the money in, you're getting around the sequence of return risk until this gal takes out all her money. Until she starts withdrawing, then she's not facing any sequence of return risk. It's just whatever turns out to be the case after her 10 years of having the money in the market is what she'll end up getting. So I think that this really does present a way for all of you on this call and everybody else you might tell them about this new way to think about investing, to not to sleep at night and knowing that, hey, my base living standard will never fall, apart from some other things that are outside of investment risk. You could have kids need money, or you have a parent you need to take care of. A lot of reasons why you can have expense risk or income risk that are unassociated with investment risk, but you don't need to be torturing yourself every night about the stock market if you're not really spending out of the stock market until you see if there's something there. So let me stop there unless you have any other comments, Rick or Dan. And I'll just go and we'll just go back to Q&A.